Two trades. Number one, I continue to be short Treasuries. And the other thing that I would do at this point in time is if I have a long dollar position, I would take strength in the dollar to take some money off there. And I think the first candidate to put it in is the euro.
Now, I'm very happy to have Panmure Liberum's head of strategy, Joe Klement, back with us.
Hi, morning.
It's a quiet week. There's no news.
No.
No.
I mean, seriously, I was like, on Monday, I came to the office and it's like, what am I going to do all week? And next Monday, I'm going to come to the office and it's like, yeah, still nothing to do here.
What has been the most important thing so far this week, or is it still to happen, do you think?
I think it is happening right now, obviously, with the market digesting the tariff news. And especially, I would say, while most of us here in Europe don't have really a big surprise, I think the massive surprise is Switzerland. 39% tariffs on Swiss imports on Swiss exports to the US. Now, that obviously excludes pharmaceutical exports. They are going to be separate, and 60% of Swiss exports to the US are drugs and pharmaceuticals.
Is that from Roche?
Roche, Novartis, Lonza, the big three, but also like small biotech companies, etc. But even so, the Swiss exports to the US, if you exclude pharmaceuticals, which I think will sooner or later be hit with a 25% tariff, which will be really bad for Ireland as well, because that's the other big country in Europe that exports pharmaceuticals to the US. But if we take that to one side for the time being, guess what? Your Swiss watches in the US are suddenly becoming much more expensive. And I think companies like Richemont and Swatch are really going to be hit today.
Let's have a look at Richemont, because we can look at the South African price of there, and you are spot on. Down 3%, Richemont, which is almost back to those April levels. Of course, the maker of some beautiful names, Cartier,
the Mont Blanc pens, for example, lots and lots of watches. Richemont is really dominant in the watch space, Longines, Cartier, those kinds of watches.
Yeah.
If you go to the top end of the watch space, Rolex obviously is private, so we don't know, but they're all manufactured in Switzerland, so your Rolex in the US is suddenly going to jump.
I've just remembered it's a Swiss national holiday. That's why they aren't open. I was looking for the Novartis.
Oh yeah, of course. It's Swiss National Day, 1st of August. And I was checking the Swiss newspapers this morning, and they are, well, their gasted is flubbered, to say, to put it like this. They did not understand why they were caught with a 39% tariff, especially because that is even higher than the 2nd of April Liberation Day announcement to begin with. And my personal, as somebody who has lived in Switzerland for 21 years, as a German, my personal interpretation is simply the Swiss try to do what they always do. They're very deliberate, very unflashy, and they try to negotiate in a Swiss way, like they always do. And then you're kind of meeting your nemesis in the phrase of Donald Trump, who wants a flashy outcome and he wants the results quick. And Switzerland and Swiss people just aren't built for that. And I guess in the end, they thought, well, we just kind of piggyback on whatever the EU gets, and then that's the same thing. And I think there's a rude awakening today in Switzerland with that.
Now, let's move on to that EU deal.
Yeah.
15% rushed through, perhaps.
Yeah.
Will there be a political fallout? And do they have to vote on whether they accept it?
No, they don't have to vote on that. So that's totally within the power of the European Commission to negotiate these and to accept these. But what really annoyed me terribly when I came back into the office on Monday, because on Sunday I wrote my reaction piece for our clients about the EU deal. And I thought, well, that's pretty mainstream. It's pretty much the same thing as Japan. So it's not great, but in the end, it's actually a good deal for Europe because effectively with 15%, they get the same tariff as their competitors from Japan and a lower tariff than Chinese competitors. So in the US, they might even gain market share from Chinese firms.
Right.
I come in and the entire press is like, this is the worst deal ever. This is a capitulation, etc. So let me make my point. Okay, I've already made my point. 15% is the same as Japan. And a week earlier, Japan got 15% and promised $550 billion in investments in the US. And it was celebrated. The Japanese market was up 3.5%.
Yeah.
Now, the EU gets 15% and promises 600 billion, which as a share of GDP is much, much less than Japan's costs. And people are like, this is a capitulation, this is an absolute disaster. Let's face it, $600 billion in investments from the EU into the US is effectively what European companies have invested since 2022 over the last 3 years anyway.
Okay.
So that's an empty promise. It's just a wonderful headline that doesn't mean anything. And the other thing was $750 billion in energy imports, at which point you have to say, over the next 3 years, the US can't even deliver that many oil and gas and coal exports to the EU.
Well, they can from Russia via the US. They can do it that way.
It's just impossible because the US, and where it really, the bottleneck is not the production capacity of US oil and gas producers and coal mines. It's the harbors. LNG ports in the US are already operating at capacity. They can't expand their capacity anymore. So this is all just literally bullshit. The 750 billion is a complete nonsense number, and the 600 billion will happen anyway.
What about the reaction of Eurodollar? So let's have a look at that chart, and you can see that it's come off from 117.5 to 114. Those are big moves.
Yeah, no, absolutely. The dollar is the Lazarus, so to say, coming back from the dead. And to be perfectly honest, the dollar was, from a sentiment perspective, very oversold. I personally like the weekly Centix survey, where people have been euro bullish more than any time in the last, I think, 20 years or so.
Yeah.
So I think this is not necessarily a massive trend change, even though I know we've broken through trend lines that are quite meaningful. I think over the next 1 to 3 years, the dollar will still continue to weaken because the fundamentals of this entire trade deal are horrible for the US.
For the US?
For the US.
Across the board, not just the European.
Across the board. So to give you a couple of numbers, and we have our own forecast. So we think that the deal as it is right now will add 1.1% of inflation over the next 12 months. So pushing US on top of 2.5. So basically pushing it in the 3.5 to 4% inflation rate in early 2026. We also expect that US GDP will get roughly 0.7% hit from those tariffs over the next 12 months. In the long run, we expect the US to be 0.4% smaller in terms of GDP economic size than it would have been without it. While the EU is actually going to be a little bit bigger.
Right.
Yeah, because as I said, they pay a lower tariff than China. So a lot of American importers, if they can't get it at home, will import it from Europe rather than China.
So together, as a US against rest of world, you still believe in this deterioration of American exceptionalism?
Absolutely.
Okay.
It's just a matter of time.
Because
and by the way, I am actually one of the least pessimistic out there. I did a little bit of an exercise. I don't really have the details of other forecasters, but I have the details of 2 other forecasters, which is the Yale Budget Lab, which makes its forecasts available for free. And they expect that inflation will go up by 1.4% and the US economy will shrink by 1% to 1.1%. Bloomberg Economics, the other ones that I have access to, expect inflation to go up by 1.8%. I have no idea what I have no idea what kind of a model you have to have in order to come up with 2%, but more than 1% drop in US GDP. In other words, the US is hitting a really big stagflationary hit now, which also means that the Fed can't really cut interest rates.
How do we put that into trades then? Because, you know, we know what we think of economists, we know what we think of their data and their models.
Go on then.
Your job is to take those models, take the theory and put it into a strategy on how to make money.
Okay, 2 trades. Number 1, I continue to be short treasuries. I am in this camp where I think the 10-year treasury yield will move towards 5% in the second half of this year. I'm still hopeful that it will cross the 5, but it might just fall short of it a little bit. But that's still, we're still talking 50 to 60 basis points higher yields from where we are today.
So you're talking about the 10-year going from 4.38 to above 5.
Yes. So as I said, it might fall a little bit short, but 50 to 60 basis points higher from where we are here. You want to short the 10-year at this juncture.
Shorting the bond.
Shorting the bond, higher the yields. And the other thing that I would do at this point in time is if I have a long dollar position, I would take strength in the dollar to take some money off there and put it into mostly, I would say, euro. I would have normally said Swiss franc in euros, but after today's Swiss news, I wouldn't put it into Swiss franc anymore. That is a good currency to be in. I also do think that British sterling could be an alternative, but I think the first candidate to put it in is the euro.
It's funny because Poppy and I on the chat, who's of course Mr. CJ Fellingham of ex-Soros, ex-BlackRock, you know, a long list such as yourself. So 2 very wise gentlemen that have been in this market for long enough to know and to call things, also thinks that GBP has a rally off the now sub 132. Bank of England next week, one of our viewers said 100% nailed on cut. What was your answer to that in one word?
I think that's bullshit. I mean, I think it's literally a 50-50 shot. And the reason is that inflation pressures in the UK are building as well. And what the PMI data shows, and yes, I say this on a day when an alternative business confidence index struck a new low. So business confidence is not that great, but in the manufacturing sector, we actually do see that. And what crucially we do see in the manufacturing sector is price pressure. Manufacturing companies report higher cost pressures, higher costs that are coming through. And if the Bank of England pays any attention to that, it is not that clear cut. Now, having said that, if they cut next week, then I think they will cut maybe one more time in December, but that's about it. Okay. And if they don't cut next week, then they will cut in September at the next meeting. So overall, I think it's a matter of timing and when, not if, because I think that the Bank of England will cut one more time, possibly 2 more times. But given our leading indicators and our confidence that the UK economy is actually strengthening a little bit, I think it's more 1 time than 2 times.
Would you rather be in Andrew Bailey's shoes or Jerome Powell's?
Oh, easy, Jerome Powell's. Much easier. First of all, I would have to do the job for less than 12 months. And second of all, the picture in terms of inflation and growth is so easy for the US. It's a stagflationary impulse. We already see in the most imported goods a massive increase in inflation in the US. And from a political perspective, if you want to defend the independence of the Fed, then you steadfastly push for no rate cuts in the second half of this year, which would be good to fight inflation. It would be good for the independence of the Fed. It would be roundabout the best thing to do.
Okay, so your idea of higher yields comes from inflation. It also comes from a stubborn Fed, rightly so.
Yeah.
What about deflationary impact of things like AI?
That is a long-term story. First, we have to basically deploy all those investments. And here, I'm totally a fan of AI. I think it is a game changer in some industries. It can increase productivity. But I'm also concerned that people get carried away a little bit, as they always do. That's a normal thing. But to be perfectly honest, if you look at not Aswath Damodaran, who won the Nobel Prize in economics last year? The MIT economist. But he says, he calculates that over the next 10 years on the US economy, the productivity gains from AI will be 1% cumulative. So 0.1% per year. And the argument he makes is that, yes, there are certain roles like being a law clerk or being a software programmer where your productivity gains are huge, but you lose some of those productivity gains because you have to check AI all the time.
Right.
You spend a lot of time checking the output that your AI gives. But if you don't, you submit legal cases to a judge and the judge finds out you're quoting made up cases and the entire case gets thrown out.
This happens.
This happened.
Yeah.
It's not happens. This happened a couple of times in the US now.
Yeah.
So you basically risk losing the case because you didn't check the AI output. So you lose a lot of your productivity gains in just checking it. And then the other thing is that, a large part of the economy is not threatened by AI. If you are a cook, well, what is generative AI going to do for you except pull out maybe a nice recipe, but afterwards you still have to cook it yourself.
Yeah. Okay, so you'd be happy to be in Jerome Powell's shoes because you would be happy standing up to Donald, who we've just heard the new acronym of DEAL, which is Donald expects a lot.
Yeah, he does. Whether he gets it is a different story.
Yeah, the art of the deal. But what about the effect on earnings and therefore the S&P 500? Because we are seeing these behemoths come through with the huge numbers and the huge capex, which feeds into benefits for other companies. Are we at a stage now where you can't, the S&P 500, there's no point in looking at it because it's only 10 companies?
So yes, so that's indeed what we also see in this earnings season very clearly. So services companies, whether it's banks or software services like Meta, like Alphabet, etc., they are doing great. Why? Because, well, they are not directly impacted by any tariffs and they're benefiting from the AI investment boom. So that's really good for them. And that is something that carries the S&P 500. The moment you go into the manufacturing space or the retail space, consumer products, you even saw it with Apple's results yesterday. They had fantastic results because iPhone 16 sold like hotcakes, but Tim Cook was honest enough to say that a lot of it apparently was people rushing to buy an iPhone 16 before the tariffs come into place and they have to pay more for it. So expect the Q3 earnings to be somewhat muted and Q4 earnings as well.
And a lower margin because of tariffs.
And the lower market because of tariffs. And then if you look at GM and other companies that rely heavily on imports, they're all taking massive hits from the tariffs. So Stellantis has taken 2 billion down and GM 1 billion, or the other way around. It's like one was 1 billion, the other one was 2 billion. But it's ridiculous amounts of money that they are basically being hit with at this point in time. So I would say the S&P 500 is going to be even more a tale of two markets, with tech services going okay. And probably the only thing you have to worry in tech services is if you really believe my story about higher treasury yields, that means higher discount rates, and that's usually not great for growth companies. And then the rest of the index, especially manufacturing and consumer goods, really in dire straits in the second half of this year.
So it's tricky to put on value versus growth because you do have a lot of those.
You can't do
manufacturing
any
companies.
of that, really. The best thing you can do is at the moment, put a quality, so high profitability, because that will naturally zoom you into some of the Magnificent Seven that is not Tesla. Good.
Yeah. Well, that takes us perfectly on to the European autos. You mentioned Stellantis there.
Yeah.
Renault had horrible numbers.
Yeah. And they don't even export to the US.
Yeah, there was no excuse.
There's no excuse.
The Chinese are coming for us.
Yes.
Now, Piers and I actually took a BYD vehicle into work yesterday.
How was it?
Do you know, it was very comfortable.
Yeah.
It looked good.
Yeah.
It did the job. The driver said that it was just a basic model, so the miles per gallon weren't quite miles per gallon on an electric vehicle.
I was just going to say the range.
the range,
The range
was
and the
pretty
consumption.
standard. Yeah. But I'd rather have that than a Renault. So where do we sit with these European autos? Because
I'm still short European autos.
Okay.
And for two reasons. The US isn't really that much of a big deal unless we're talking about Aston Martin or Porsche. But mostly it is about the lack of demand from China.
Yeah.
So whether we're talking Volkswagen, Mercedes, etc., they're all struggling in China, which has become their largest or second largest market. And then the competition in the EV market. All over Europe, the European manufacturers are still years behind Tesla and the Chinese.
And billions of capex.
And billions of capex. And my favorite statistic is if you look at new electric vehicle car sales in 3 years ago, 2021 or 2020, Chinese EV manufacturers were less than 3% of new electric cars. At the end of 2024, we're talking about 24%.
Oh.
So they basically are, at the moment, cleaning up the entire market. Because one thing we learn is that while there's a lot of brand loyalty, and I say that as somebody whose dad worked for Mercedes-Benz his entire life, everybody in Europe, especially in Germany, we have a lot of brand loyalty. Once a Mercedes guy, always a Mercedes guy. You don't switch to BMW because you will be disinherited by your dad. I can tell you that. But to change to an EV, people are willing to try something new.
Yes, very true.
That's such a big structural change.
Yeah.
And then they sit in a BYD or an MG or a Tesla, and they find out, well, it's actually just as good a build quality as a German-made car or a French car.
I can't believe what I'm hearing. Please don't put German car and French car in the same sentence.
Yeah, okay. All right. That might be a bit much, but German car.
You said you're still short European autos. What's the long against it?
So at this point in time, the longs, I am still long European banks. And I have to say BBVA has jumped 6% the last couple of days after they presented great earnings. UBS has done extremely well as well. So I'm inclined to take profits there. The ones where I am still very long is airlines, in particular IAG, the owner, International Intercontinental Airlines Group, which is the owner of British Airways and Iberia. But also EasyJet, Ryanair, traditionally a terrible airline to fly with, but a great stock to own. It's a bit expensive at the moment, so I would prefer EasyJet and IAG, but they are really great stocks to have. Yeah. And then the other ones is more in the leisure sector. So European hotels like Accor, like Whitbread, those kinds of guys that are benefiting from more tourism within the EU as Europeans have a little bit more money to spend.
Now, that is a way that strategists play the market, right? Let's have a look at these iShares sector swaps. These are available on the IG platform, and they're a great way to express your view. You can be short the autos and then long the airlines. You can be long the banks, You could be long basic resources and then short, take your pick. What would the second short be, do you think?
Ooh, a second short is, yeah, it's on a basic resources side, I would say in Europe, yeah, basic resources. Because the exception to that is gold miners with gold going through the roof. But all the other miners and companies in the basic resources sector like cement, etc., and steel are just not that great to own at the moment.
So really excellent value from you this morning. Thank you so much. Fantastic. Dankeschön.
Gern geschehen.
Tschüss.